Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
All right, buckle up, because this past week in global markets was quite something. A huge surge, really, a big jolt of energy.
Yeah, all driven by that U.S.-China tariff truce that, well, frankly, many thought might not happen.
Exactly. Equity markets just absolutely took off. Felt like a real release of pressure.
Thrilling is a good word for it. I mean, it was a pretty seismic shift in sentiment, wasn't it? For months, those trade tensions were like this dark cloud hanging over everything.
Totally. And this sudden, de-escalation just seemed to unleash a wave of optimism.
A torrent, yeah.
Okay, so let's dive right in. We've got the numbers, we've got the data, and we need to unpack what this whirlwind really means, region by region.
And crucially, what you, the listener, should be keeping an eye on in the week ahead.
Absolutely. Yeah. Consider this your high-octane briefing on global finance this week. Let's kick off stateside. The U.S. reaction was, pretty explosive.
It certainly was. The U.S. markets, they posted their best week in months.
No kidding. I mean, look at these numbers. S&P 500 up a hefty 5.27%. The Nasdaq just flew 7.15% higher.
And even the Dow Jones put in a solid gain, what was it, 3.41%?
Yeah, 3.41%.
Yeah.
Now, the obvious catalyst, as we said, was that U.S.-China deal. Can you break down what actually changed, what flipped the switch?
Well, the core of it was a 90-day pause on any new tariff hikes, plus a rollback on some existing ones. Basically, it just got a bit cheaper to move certain goods between the U.S. and China.
Okay, specific numbers.
Right, so U.S. tariffs on some Chinese imports are set to drop quite dramatically, actually, from 145% down to 30%.
Wow.
And China's tariffs on certain U.S. goods, they're coming down from 125% to 10%. So, it directly tackles a big piece of that trade friction we've all been watching.
Right, okay, so tangible relief on trade. But, when you dig beneath the headlines, the U.S. economy itself, it's a more complex picture, isn't it? It wasn't all just positive news.
Exactly right. While the market was popping the champagne over the trade news, the underlying economic data suggests maybe we shouldn't get too carried away just yet.
Okay, like what? Inflation?
Yeah, on inflation, we did see some welcome cooling. April's CPI, the Consumer Price Index, came in below expectations at 2.3% year over year.
That's good.
And the PPI, Producer Price Index, which tracks what businesses pay, it actually fell 0.5% month over month. Now, that dip in PPI could hint at some potential pressure on company profit margins down the line.
Interesting. So lower costs now might mean squeezed earnings later, but then the consumer, right, the engine of the U.S. economy, that data looked a bit softer.
Precisely. Retail sales growth really slowed down in April, up just 0.1%, suggests consumers might be, tightening their belts a little. And maybe more concerning is the University of Michigan's Consumer Sentiment Index. It's down for the 5th month straight.
5 months, okay.
And what's really noteworthy there is that within that survey, people's expectations for future inflation actually ticked up to 7.3%.
Oh, okay. That's ideal.
It's a potential red flag, yeah. Because if consumers expect prices to keep rising fast, it can influence spending, wage demands, maybe even feed more inflation.
So the big takeaway from the U.S. then is this kind of tug of war. You've got the market's immediate joy over the trade truce, but these more cautious signals from the consumer and those inflation expectations bubbling underneath.
That's a great way to put it.
Okay, let's cross the Atlantic. Europe. How did markets there react to all this?
European stocks pretty much rode that same wave of global optimism. Eased trade tensions helped lift the mood. The Stoxx X Europe 600, the broad benchmark, gained about 2.10%.
Any standouts?
Italy actually had a strong week. The FTSE MIB jumped over 3%, 3.27% to be exact. The German DAX, French CAC 40, they also posted gains, maybe a bit more measured, though.
Okay, so a general lift from the global mood. What about the Eurozone's own economic story? Any positive domestic data?
There were actually some encouraging signs, yeah. Industrial output across the Eurozone saw a really significant jump in March, up 2.6% month on month.
Wow, what drove that?
Mostly strong production of capital goods, think machinery, equipment, that sort of thing, and also durable consumer goods, cars, appliances. And we also saw a record trade surplus, EUR 36.8 billion in March. Interestingly, a big driver of that was more exports heading to the U.S.
Ah, okay. And jobs?
Employment looked pretty resilient, too, up 0.3% in the first quarter. So, yeah, some positive signals there.
That sounds like decent momentum. Does this put Europe in a stronger spot now?
Well, these are definitely good signs, but it's important to remember the overall recovery in Europe is still seen as, well, somewhat fragile. It's quite susceptible to shifts in the global economy.
Right.
So that trade truce helps, especially for export-heavy economies, but, the bigger challenges haven't just vanished overnight.
Understood. Fragile, but showing some positive signs. Okay, let's hop over to the UK. Always seems to have its own unique story playing out. What happened there?
Well, the FTSE 100 saw a decent gain, about 1.52%. But the really interesting thing in the UK was that surprisingly strong Q1 GDP number.
Oh, yeah, I saw that. It was pretty good, wasn't it?
Very good. Up 0.7% quarter on quarter. That's the fastest growth rate they've seen in a year. Looked like services and exports were the main engines there.
That's a real headline grabber. But I remember seeing some conflicting signals, too, especially the labor market. What's the deal there?
That's the crucial counterpoint.
Yep.
Yeah. Despite that strong GDP print, we're starting to see maybe some fault lines appearing in the jobs market.
Like that.
Unemployment nudged up a little to 4.5%. And maybe more worryingly, the number of employees on payrolls actually fell at the fastest pace in a year.
Okay. So strong growth, but jobs may be weakening. That's a bit of a puzzle.
It creates some uncertainty, yeah,
Yeah.
about future consumer spending, the overall path forward.
And what's the Bank of England saying about all this? Any clear direction on interest rates?
Their messaging seems a little muddled right now, actually. The bank's chief economist, Hugh Pill, he recently suggested inflation might be stickier, more persistent than they thought, which sounds a bit hawkish. But then you have other policymakers voicing concerns about the economy, suggesting rate cuts aren't off the table. So this lack of a clear, unified message leaves the market guessing a bit.
Right. So solid growth for now, but definitely need to keep a close eye on those job numbers and what the Bank of England signals next. Okay, let's pivot to Asia. Japan first. Their story often seems to run a bit counter to the global flow.
That's a very accurate way to put it. While most markets were cheering the trade news, Japan's own economic data painted a much less rosy picture.
So the market gains are small.
Very modest, yeah. The Nikkei 225, the TIPS index, both up less than 1%.
And why was the reaction so muted there? What was dragging things down?
The main issue was that really quite weak Q1 GDP data. The Japanese economy actually contracted by 0.7% on an annualized basis.
Ouch. Was that expected?
Worse than expected. Significantly worse, actually more than triple the decline economists were forecasting. It seems to be mainly down to sluggish consumer spending domestically, and external demand wasn't helping either.
That's a pretty big setback. How did the Bank of Japan react?
Well, they acknowledged the weaker growth. They lowered their forecasts for the economy. But interestingly, they kept their cautious stance on raising interest rates further. They still seem worried about inflation, even with growth slowing.
And the yen?
The yen actually held pretty steady against the dollar, ended the week around 145, despite some wobbles earlier.
That's good. So Japan's got its own headwinds, clearly. Weak domestic demand seems to be the big story there, kind of overshadowing the global trade relief. All right, finally, let's look at China, the other key player in that tariff truce. How did their markets react?
Well, Chinese equities got an initial positive jolt from the trade deal news. The Shanghai Composite, the CSI 300, Hong Kong's Hang Seng, they all registered gains. The Hang Seng actually did the best.
Makes sense. I mean, the deal itself was seen as quite favorable to Beijing, wasn't it?
Very much so. It was widely framed as a kind of diplomatic win. It met a lot of their demands, reversed a big chunk of those U.S. tariffs.
Okay. But I noticed the gains seemed to sort of fade a bit as the week went on. What happened there?
Yeah, that initial burst of optimism was followed by a more, let's say, measured response. I think investors started recalibrating their expectations about more stimulus coming from Beijing.
Ah, right. They'd already done some easing, hadn't they?
Exactly. Earlier in May, the PBOC, the central bank, cut the reserve requirement ratio for banks, the RRR, and lowered a key short-term lending rate, the repo rate.
So the market thought maybe that was it for now.
It seems that way. The thinking shifted, maybe less conviction that a huge new stimulus package is coming right after this trade relief. So, yeah, the focus shifted a bit.
Got it. So trade truce was good news, but now the focus in China is less on expecting big stimulus checks, more wait and see. Okay, fantastic overview. Now, looking ahead, this coming week, May 20th to 24th.
Yeah.
What are the absolute must-watch data points and events?
Okay, key things on the radar. In the U.S., Wednesday, we get April existing home sales, then Thursday, April durable goods orders. That durable goods number is particularly interesting.
Why is that?
Because it can give us a clue about business investment, CapEx. Are companies feeling confident enough after the trade news to actually spend on big-ticket items like machinery?
Right. Good point. What about Europe?
Europe, we've got the flash Eurozone Consumer Confidence on Wednesday. And then Friday, Germany's Ifo Business Climate Index, always closely watched.
Okay. UK?
UK is crucial on Tuesday, April CPI inflation data. That could really move the needle on Bank of England expectations.
Especially after those mixed signals and softer wage data.
Precisely.
Yeah.
Japan also has its April CPI out on Friday. And interestingly, China looks relatively quiet on the major data release front this week.
Okay, so still a packed week, especially for inflation watchers.
Yeah.
Which specific releases do you think could cause the biggest ripples?
I'd really highlight those U.S. durable goods orders. A strong number could suggest businesses are genuinely more optimistic, which is good for growth.
Makes sense.
The UK inflation print, as we said, is absolutely critical. Given the BOE's current ambiguity and the recent jobs data, this number is huge for rate expectations. For Japan, the CPI data is important for the Bank of Japan. Are price pressures building enough for them to consider tightening, despite the weak growth? That's the question.
Right.
And in the Eurozone, that consumer confidence reading will be an early indicator. How are consumers feeling after the tariff suspension news?
Got it. And beyond the specific data, what about the broader risks? What are the top, say, 5 things that could wobble the markets this week?
Okay, top 5 risks I see. First, U.S. consumer fatigue. Those weak retail sales, falling sentiment, if that signals a deeper slowdown, it hits Q2 GDP, corporate earnings, that's a big one.
Yeah.
Second, the Bank of England's rate path ambiguity. Those mixed messages mean data is critical. Sticky inflation showing up in that CPI print could really derail hopes for rate cuts soon.
Okay, risk number 2.
Third, China's stimulus uncertainty. If investors keep dialing back expectations for more support after that initial easing, it could dampen risk appetite, especially across emerging markets.
Makes sense.
Number 4, Japan's growth risks. That Q1 contraction raises real questions about their recovery's sustainability. It could really tie the Bank of Japan's hands on normalizing policy.
Right. And number 5.
Finally, the Eurozone's industrial bounce-back fragility. That good industrial data we saw, it might not last if consumer and business demand doesn't pick up alongside it. The momentum could stall.
Okay, so quite a few potential bumps in the road there.
Yeah.
So just to quickly recap the whole week then, markets loved the U.S.-China trade truce. Big relief rally.
Absolutely dominated the narrative.
But underneath that excitement, the actual economic data is, well, it's complicated. You've got slowing growth signs, inflation still sticky in places, and this whole reassessment of stimulus in China.
Exactly. That initial wave of optimism was powerful, no doubt. But whether it actually lasts depends heavily on the fundamentals coming through.
Right. If the data doesn't back up this risk-on feeling,
Then we could easily see volatility return.
yeah. Which is why keeping a laser focus on those upcoming releases this week is just essential. They'll either confirm the mood or throw a whole new set of questions out there.
Precisely. Is this rally built on solid ground, on real economic improvement, or is it just, a temporary sugar rush from the trade news?
So as we wrap up this deep dive, the big question for you to think about is exactly that. How is this interplay between, let's call it geopolitical relief and fundamental economic strength or weakness going to shape things in the coming weeks and months?
Is this the start of something sustained or just a pause?
Exactly. Something to really chew on until we're back with our next market briefing. Thanks for tuning in.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.